It's 9:30, folks, and class needs to be started. And I'll wait and take roll so who else comes in. But we usually have about 12. Don't even have half of you yet. You know you have a test Thursday. So let me tell you exactly what problems are on that test, okay? I want to repeat these one time. I'm not going to repeat them for those people who are late. You all can share with them if you want to. But you'll have 10 multiple choice, and some of those multiple choice you may have to calculate interest on a note. You may have to split income on some kind of ratio. You may have to meet a partner and give somebody a bonus. All right, now the problem one, journal entries for a note and paying the note. The easy problem, journal entries for a note and paying the note. Problem two, well, these are exact, folks. Warranties, those contingent liabilities, will there be a court settlement, warranty litigation expenses? Anyway, those are those contingencies. What interest do you make if you're being sued? So go back and review that part. We did the warranty, but we didn't do the litigation too well. And problem three, partner will put his assets into a business at fair market value to start a partnership. Problem four, you'll split income between or amongst partners. Partner five, a short liquidation problem. You're going to sell the assets, you're going to split the loss or gain, you're going to pay the liabilities, and then you're going to distribute all the cash. That's just journal entries for that, and you'll have to do that liquidation form. Prepare that liquidation form. I will provide journal paper, okay, for journal entries. So it's 6 problems and 10 multiple choice. I don't think you'll have a hard time with it. Fraser, how you doing on Cengage?
I'm on 28 of 38 on 12.
All right, on chapter 12 or 38?
Yeah.
Antonio, have you got caught up with chapter 11 on Cengage?
Okay, so that's a good
All right. I'll give you a little extra time on chapter 12, Antonio, but a week from today you should have both of them caught up because we're going to be on chapter 13.
Okay.
Okay. All right. Is there anything you want to review? I think you know the partnership entries and the partnership splitting income. I think you can admit a partner by giving the old partners a bonus or the new partner a bonus. And I think you can liquidate. And that's what chapter 12 is about. All right. Now, what was chapter 11 about? The warranties, the notes payable, and the payroll. And you made 2 major journal entries for payroll. All right. One you paid the payroll, and one the payroll tax expense on the employee. So if you are good to go, we need to move on, and we'll move on to chapter 13. Okay. All right. Now, I am here around 8:30 on Thursday. And I don't believe any of you sitting here at this moment, I don't believe you have a class at 8:30, do you?
Yep.
You do, Elise? I'm praising. Well, get here as quick as you can. If you don't have a class, like I say, I'm here at 8:30. If you need extra time, I've got a class that starts, I guess it starts at 11. So, I'll give you an hour and a half, even if you got here on time. An hour and a half will be plenty of time. All right, now corporation, folks, we're in new, uncharted territory. You've had a proprietorship and you've had a partnership. Corporation. Every company you see around you is a corporation. You might see a few proprietors or partnerships, but if you go into retailing out the mall, they're incorporated. Is JCPenney still out the mall? Which I read in the news somewhere yesterday that JCPenney's is in big trouble. They're about to get kicked off the New York Stock Exchange. Their stock has went down 93% since 2016. And JCPenney's hasn't done anything to dig out the hole. So, but anyway, they're incorporated. And most of the stores you see out at the mall are incorporated. Now you might see a proprietorship, some little spot set up in the middle of the hall selling jewelry. That'd probably be a proprietorship. But your partnerships may be law firms, maybe doctors or dentists, what have you. They may be set up as an LLC also instead of a partnership, so they have that limited liability. Well, here's a corporation. They are a legal what? Legal what? All right. Now, if you go down and slide on a banana peel, I'm down in Pop's grocery store in the corner, and it's a proprietorship. Who do you sue? You'd sue Pop, wouldn't you? Now, if it's a partnership, and Mom and Pop owned it, and you slid on a banana peel, you'd sue Mom and Pop. But if they were incorporated, if it's Mom and Pop incorporated, you'd have to sue the corporation. And corporations get sued. Look at the cigarette corporations that have been sued. McDonald's have been sued for hot coffee. Ford has been sued for some of their automobiles catching on fire. But just different companies have been sued for whatever. For making shoddy products or dangerous products, and so on. So a corporation is as a person, it's a legal entity. You are a legal entity yourself. And we're going to sell stock. In a corporation, we sell stock. So you're going to learn a little bit about the stock market, okay? Stockholders are just that, stockholders, okay? They are the owners of a corporation, sometimes called shareholders or stakeholders. Now, the New York Stock Exchange has a Dow, which is the top companies in the country. You can go down here in Bluefield. I'm sure there's a trader in Bluefield. I can't think of their names right now. It's in Bluefield. You can go down and buy and sell stock. Some stock you can buy straight from the companies themselves. Or you can go to the bank. You can buy over-the-counter stock, maybe from a bank, but you can get stock if you want it. There's a lot of online organizations that sell stock. I deal a lot with E-Trade. They sell stock. Now, I bought some Disney stock from E-Trade, I probably told you this before, for $19 a share. Well, yesterday it was selling for $142. So, 5 times. My stock has went up 5 times, okay? However, I bought some other stock I may have lost on. 1-800-Flowers, I bought some stock in Nike and so forth and what have you. But anyway, the organizational structure of a corporation, you got the shareholders, they got a board of directors, and they appoint the CEO or the main operating officer, whoever it may be, and then under them are the employees. Now, some of these major CEOs of these corporations, you know, $1 million a year is a small salary. So some of them make $20 and $30 million a year. They're appointed by the board of directors, but that's not all that important. A corporation has to file a tax return because it's a legal entity. And they have to pay taxes, of course. Now, a shareholder, you pay taxes on dividends that you receive. There was a bank in Southwest Virginia. They sold stock for $10 a share when they started, and that stock went up to $100 a share, and it split. And then it went up to $100 a share again. So your $10 investment, you'd have had 2 shares worth $100 apiece, $200. That's what some of the bank stocks, people got wealthy with the increase in stock. There's advantages and disadvantages of a corporation like anything else. Too big or too little? Let's see. Might be just right. A corporation exists separate. It has continuity of life. If one shareholder dies, the corporation goes on. It can raise more money. The stockholders cannot lose their personal assets. So it has a separate legal existence, continuity of life. They can raise more capital. You can transfer your stock, and the owners have limited liability. That's why a lot of places incorporate. Disadvantage, owners are separated from management, double taxation, and regulations. Now, Trump brought the taxes down to 20%. It used to be 39 to 49%. So corporations pay less taxes now. But some would always assume, economists would say, if a corporation pays 39% tax, they pass it on to you anyway when you pay for the goods. All right, owner is separate from management. And sometimes management rip you off. Now let's take Alicia. Now, if she was a kleptomaniac, and she just had to shoplift, She wouldn't do it from Pop's grocery store in the corner. She probably knows Pop. She wouldn't shoplift from Pop. But now Walmart, that's just a big old company. She don't know any of the owners. She'd shoplift from Walmart. Okay? Or J.C. Penney's. All right. So corporations, there is more shoplifting amongst corporations. You've got to get a charter from a state corporation, commission. You can write to State Corporation Michigan of West Virginia and get the papers and incorporate a one owner business. You can incorporate a proprietorship or partnership or whatever. You can actually incorporate yourself. Now, to incorporate you, an attorney may charge you $4,000 or $5,000, a CPA $2,000 or $3,000, and you can do it yourself and just pay $75 for the incorporation fees. There are a lot of big corporations, and where they are home office, Caterpillar, Delaware. But the home office in Illinois, John Deere, Delaware, their home office is in Illinois. And here Delta Airlines, home office is in Georgia. The Home Depot, home office, Georgia. Kellogg Company, I guess cornflakes, what have you. Their office is in Battle Creek, Michigan. R.J. Reynolds Tobacco, Winston-Salem, North Carolina. Would you believe it? That place stayed smoker friendly for a long time. Starbucks, Seattle, Washington. 3M Company and so on, Minnesota. Whirlpool, Michigan. You get a charter, of course. Come in, guys. Legal fees for a corporation are higher than for proprietorship. You got to pay state corporation fees and license fees and so on. Now you debit these expenses when you start a corporation, organizational expenses, and credit cash, of course, or credit accounts payable, whatever the case may be. Now, we've been having assets is equal to liabilities plus capital. That changes now. It's going to be assets is equal to liabilities plus stockholders' equity. Capital now changes officially to stockholders' equity. And you're going to have retained earnings. That's where you put your income. And a corporation pays dividends. That's like a withdrawal in a proprietorship. We'll get to retained earnings later. All right, a corporation may authorize 100,000 shares of stock. All right, they may issue 70,000 shares of that stock. If they buy back their own stock, then you may only have 60,000 outstanding. Outstanding is what you pay the dividend on. Not authorized, not issued, You pay a dividend on outstanding stock. Are any of y'all major in health service?
I am.
Amy, you know about Miss Grover, don't you? Thursday when I was up here, there's two police looking for her. She didn't work on Thursday. Her husband, I think he'd had a stroke a long time ago, and he wasn't doing great anyhow, but he was substitute teaching, and he went out driving Thursday morning, had an accident. It was a one-car accident, I guess. His car hit a tree and it went over into a field and what have you. Bottom line, he's in the Roanoke Hospital. I think it broke a couple of ribs, been placed on his head, broke his pelvic bone, and I don't know what all, and injured his back real bad. So she'll probably, as she communicated with you all, she'll probably do stuff live streaming.
Yeah, she's not gonna be here at all this week.
Yeah, I doubt that she would, yeah.
We were supposed to have a test yesterday, and she sent out an email over the weekend that she was gonna put it online, and we could just do it online between yesterday and tomorrow night at 11:59. So instead of coming in. Just do
Well,
it.
just all of y'all be patient with it.
Oh, I am. I don't have nothing on.
Shares of stock have a par value. We've got to put a par value on the stock. Now, we're going to have to learn par value, market value, stated value, and so on. I'm trying to bring up the stock market, show you a couple of things. Don't invest in the stock market unless you have money to lose. But here's what the stock market looked like yesterday. Well, at this moment, right now, NASDAQ is up a little bit this morning. S&P is up 1% something. And your Dow, wow, it's up 433 points this morning. Doing great. And NASDAQ's up 110. S&P then is up 38. These are percents. So the market's doing great today. Okay. These are just some other markets, I suppose, mid caps and some other countries, their stock exchanges. But you can look up market. Now, if they have a symbol in here, I'll put in DIS. I was trying to get it to bring up the Disney stocks, but you can go to a place. If you ever invest in stock, there's plenty of sites on the web that you can go, what have you. Or you can just type in an individual stock. Now this is up to 100 and almost 44. It's went up this morning $2.62. So my $19 investment per share is still growing, isn't it? I bought 100 shares. I wish I'd bought 1,000. 100 shares, I paid $1,900. Now that's worth $14,393. So, but I wish I'd have bought a lot more at that time. So you can make money in the stock market, but you can lose money in the stock market, okay? And don't ever invest in the stock market unless you have money to lose. Par value. All right. Now that Disney stock could have been selling for the par value may have been $5. I bought it for 19. That was the market value at the time, but the market value now is about $144. Market and par hardly ever match, and we have to account for that in journal entries. Stock gives you the right to vote, the right to share. Now, the thing about a corporation, you must learn corporation. You've only got a couple of chapters. It goes on for anybody in accounting. It goes on in intermediate accounting, advanced accounting, cost accounting, managerial accounting. It's corporation. Finance. I don't care if you're a management major or accounting, whatever. You've got to take finance. It'll be dealing with corporation. Okay? So we need to look at the statements of a corporation. Two classes of stock. One is common and one is preferred. Let's see, I guess everybody's here that's going to be here. So, Devon did not make it this morning. Brooke did, Tony did, Fraser did, Marcus. I don't know if he's having a shoulder operation or what. Natasha didn't make it this morning. Everybody else did. Okay. All right. Common stock and preferred stock. Common stock gets to vote. Preferred stock does not. Now, preferred stock may have rights to dividends, which we will practice. Common stockholders get dividends first. No, preferred does, then common. Now, in case of bankruptcy, everybody gets paid. All the debts get paid. Preferred stockholders get some kind of paying. Bondholders, common stockholders are the last to get anything out of bankruptcy. But there is money to be made in common stock. Cumulative, if you got cumulative preferred stock, if your corporation can't pay you a dividend 1 year, they'll pay you the next year. Double. Cumulative. And we'll see what that means in a minute. I'll get back to those dividends in a minute. Look at this exercise. Let's see what you can do with it. This company has 20,000 shares of cumulative preferred, 1%, $100. Now, if it's 1% per 100, that's $1 per share. Well, that's $20,000. Now, you also take $20,000 and multiply it by 100. That's the total value of preferred stock. Multiply 20,000 by 100. See what do you get? $20,000 by 100. What do you get? Now multiply 10 million times 2 million, right? Multiply 2 million times 1%. 20,000. So 1% per 100, that's $1 a share times 20,000 shares is 20,000. Now, preferred is supposed to get $20,000. How much do we have in year one to give out? How much are we in arrears? Now, arrears means behind. All right? Just like rear means behind. So, arrears means behind. How much are we behind? All right? So, we're going to give preferred and common stock. We're going to give preferred 10,000. But we've got 10,000 in arrears. Whoops. Common stock gets 0. Common stock gets 0, and arrears is $10,000. All right, how much do we owe preferred stock in year 2? $30. Where'd you get 25, Amy?
I didn't, I said 45, because I'm
Oh.
reading off 40.
No, they get 20 plus the 10 in arrears. And how much does common get now? The remainder of how much? And how much is in arrears? Now in year 3, how much does preferred get?
20.
Exactly. And common gets 60. Nothing in arrears. Now, some other calculations here, if you can make out my numbers there. How much did preferred get per share right here?
$1.50.
All right, they got how much here? 50 cents, $1.50, and $2. That averages out to $2. Wait a minute. Here's $1.50, $1.50. That averages out to $1 a share. It has to average out to $1 a share. All right. Look at the answers on this. And they should be the same answers we just calculated. All right. And the same answers that Fraser just gave me, $50, $50. But now common got nothing per share here, 15 cents a share here and 60 cents a share here. But common, you only had to pay how much per share? $50, and preferred you had to pay $100. We're going to practice that later. So let's see if you can practice what I just gave you. Let me give you a problem. What brought that up so clean today? Usually, I don't know. All right, let's say you've got preferred stock, 50,000 shares at $50 par, and it pays a 5% dividend. And you've got common stock, 100,000 shares, and it's $1 par. All right, now you've got income. In year 1, year 2, year 3, and year 4. Trying to see what the dividend would be on that. Somebody multiply 50,000 times $50. That's shares, not dollars. 50,000 shares times $50 times 5%. How much does that give you?
125,000.
Right here we're going to have 100,000 year one, 110,000 year two, 180,000, and then 500,000. Tell me how much goes to preferred stock in each year, common stock in each year, and make sure you get your arrears. So fill in that chart, I guess, is what I'm trying to say. All right, how much of this 100 does preferred get? All of it. Because Fraser calculated 50,000 times $50 par times 5% was 125, right? Common gets none. How much is in arrears? Now, how much do we owe preferred? We owe them 125 plus 25. We owe them 150, but we can only give them 110. Common gets none. How much is in arrears? How much is in arrears? All right, how much do we owe them in year one? How much do we owe them in year one? 125. So we got 25 in arrears. How much do we owe them in year two? 125 plus 25 is how much? 150. We can only pay them 110. How much is in arrears? Good. Now, we owe them 125 plus 40. That's how much? And they get 165. So how much does common get? They get 15. with nothing in arrears. And down here, preferred gets 125, and common gets 375. All right, that's the story of preferred stock that has cumulative dividends. You can't pay it 1 year, it accumulates, you pay it in another year. Okay. Non-cumulative. If this stock was non-cumulative, it'd be easy. Preferred would get 100 here, 110 here, and 125 the rest of the way, if it were non-cumulative. All right. So that's dividends on preferred stock. But we need to start looking at some journal entries. On preferred stock. Okay. Issuing stock. All right, when we sell stock, we debit cash. And we credit to stock. Now, when you start a proprietorship, you debit cash and you credit Fraser Capital. Start a partnership, you debit cash and you credit Brooks Capital and Amy Capital. But you start a corporation, if Amy and Brooks start a corporation, and they sold each other stock. Here we debit cash for $1.5 million, preferred stock for $500,000, common stock for $1 million. The owners now are the common stockholders. They vote. Preferred stockholders have preference as to dividends. And notice here that this stock is sold at par. They are sold at par. Well, I found out something new. I tried to move the screen with my fingers, but my fingers were also right. Didn't know that. Yeah, how about that? I thought it had to be this pen. Now, here's what we're going to deal with. We're going to sell stock at a price other than what? Par. All right, now here is preferred stock. Multiply $50 times 2,000. What do you get? That? No. Multiply 50 times 2,000.
50. Oh, I was looking at 55, sorry.
That's 100, right?
I'm pretty good at this one.
I'm not either. But if you multiply by 55 like Amy did, you get 110. You're selling it for 110. The par value is only 100. What do you do with the other 10 is my question. What do you do with the other 10? You credit it to what? Paid in capital in excess of par. Preferred. It may be paid in capital in excess of par, common. And there'll be other reasons you'll have paid in capital. It's like a premium. A premium is paid in capital. Now you 4 guys that came in late, these 5 people in front here, they have the details of the test Thursday. They have what problems I put on the test. So you four that came in late, if you want to ask any of these five, they can tell you what problems are on the test Thursday. And then starting Thursday, I'm going to have a time clock for everybody to clock in. And you're docked for every minute you're late. No, we won't do that. Now, you might issue stock for assets. Now, Amy and Brooke might have started a corporation, and Amy puts in some land. Now, the land has 120,000 fair market value. The stock, Amy's getting 10,000 shares, worth 100,000, but selling for 120,000, which you had a premium of $2. So you put the land on its fair market value, you credit the stock for its part, and anything else is a premium which is paid in capital. Now, once again, if Brooke started a company and put in land, she'd debit land and she'd credit Brooke capital. But now, we credit common stock. Sometimes there's a no par stock. Anyhow, a no par stock, but some states put a stated value on it. Couple things. Who wants the Super Bowl Sunday? Did it go your way? Mine too. Do you like the halftime show? Fraser said he liked a lot of skiing. And he got it in the halftime show, right? Okay. But one thing about it, for their age, 40 and 50, they were physically fit. Alright? I think Sakara works out 6 days a week, and she eats a lot of protein and healthy and veggies, and stay in shape. Do those shows. They put on a statement for Latinos, because they're both Latino, and that's why she had the Puerto Rico flag there at one time. Puerto Rico is supposed to be our 51st state someday. Anyway, that was useless information. Now back to accounting. None of that will be on a test. Alright, we got to issue no par stock. No matter what it sells for, you just debit cash and credit common stock. No matter what it sells for. But now if it has a stated value on it, some states require this, and you sell it above stated value, guess what you credit? Paid in capital in excess of stated value. Paid in capital in excess of par. You're always going to put that premium in the paid in capital. All right, here are some entries. One, we sold stock for cash at par. We sold preferred stock at par, but we're here we sold preferred above par. Now dividend, has to come out of retained earnings. And of course, cash. A dividend has 3 dates. Date of declaration. You declare a dividend. And you debit. Alright, when you declare a dividend, what do you debit? Now, books do this different. We'll see how this book does it, but sometimes you debit retained earnings. That dividends come out retained earnings. Debit retained earnings and credit cash dividends payable. The date of record, there is no journal entry. Now here you'll have a journal entry. And the date of payment, debit cash dividends payable and credit cash, you have a journal entry. Now they're not going to use retained earnings like I told you. They're just going to debit cash dividends, take out retained earnings later, and credit cash dividends payable. That is the declaration date. And then the payment date is easy to see. Now, sometimes you give a stock dividend because you can't by the way, that Disney stock that I paid $92 for it went up to about $144 today. I get a small dividend every year on it, about $100 dividend every year. And they also sent me a Disney watch when I bought that stock. So I got that Disney watch at home somewhere. Anyway, so you can make profit 2 ways off stock. You get a dividend or you sell it for a gain. So you make a profit 2 ways. With a stock dividend, they give you shares of stock. If you own 10 shares of stock or 100, and they give a 5% stock dividend, how many shares are you going to own now? You had 100, they give a 5% stock dividend. How many shares do you own now? Add 5 to that, you own 105 shares. Now, if you paid $10 a share for your stock, how much do you have invested? What's 10 times 100? What's 10 times 100? Amy, you don't need a calculator.
I do, my brain.
Elisa, 10 times 100, dear? $1,000. Now, you've got $1,000. You've got $1,000 invested in 105 shares. Now, what is your basis per share? How much you have invested per share? Divide 1,000 by 105. What you got?
9.5.
How much?
9.5.
9.5? It's got to be 90-some dollars. 1,000 divided by 105.
9.523.
9.53. Instead of $10 a share, you're right, 9.53. It's $9.53. So I'm tired too, just saying that 9.5. But that'd be 9.5. All right, your price per share went down. If you sold some of your stock, 5 shares of it or 10, your basis is $9.53. Now, IRS is going to charge you capital gain tax if you sell stock, but it's only 15%. Here we're selling stock. Now this is tricky. We'll have to work on it. We gave out a stock dividend worth $31 a share. We're giving out 100,000 shares. Well, that's 3,100,000. Now the par value of that stock is 2 million. So we had a paid in capital 1,100,000. Now, Amy, can you read this line for me right here?
Stock dividends distributable.
All right, you got it. Some students have trouble saying distributable, like I. And then you debit stock dividends distributable and credit common stock when you issue the stock. It does not change the assets, liabilities, or the total equity. We're not going to practice these sample exercises. Stock splits do not require journal entry. You own 100 shares. If it splits, 2 for 1, now you own 200 shares. But now the par value will also split from 10 to 5 or what have you. See, here you have before split, you had a 5 for 1 split. If you had 100 shares, now you would own 500. Now, if the par value was 100, divide that by 5, it goes down to 20 par. Treasury stock, if you buy back your own stock, that's a big part of the chapter also. Now, first off, why do you want a stock split? Well, one thing, to bring down the price per share on the market. Some of these companies, I guess like Amazon, maybe around 800 some a share. It's a lot. So you have a stock split. You have a stock dividend sometimes because you don't have cash to pay a cash dividend. But why do you buy back your own stock? You retain control. Remember, whoever owns 51% of the stock controls the corporation. If Amy and Brooke own a corporation, Amy owns 49% and Brooke owns 51%, Brooke can make all the decisions without even asking Amy. If you buy back your own stock, here is the entry: debit, treasury stock, credit, cash. Now, just a couple comments, we'll call it a day. If you buy back your own stock at 45, now, if you sell it more than 45, you got a bonus. If you sell it less than 45, you got a loss. And here we sold it for 60. So we had a $15 a share bonus, and we call it what? Paid in capital. Everything's paid in capital. It may be from selling par value stock or preferred stock or stated value stock or treasury stock, but the gain is always paid in capital. All right, now if you sell it at a loss, you paid 45, and you sold it for 40, then you have to debit paid in capital. All right, I'm not going to cover any more corporations with you. You've got a test coming up Thursday. Be here at 8:30 if you want to, no later than 9:30. Guys, if you come dragging in here at 10 o'clock to take the test Thursday, you have no extra time. All right, you will quit at 11 o'clock like everybody else when the next class starts. So some of you are coming at 8:30, some of you are coming at 9:30. I hope nobody comes at 10 o'clock. See you Thursday.